In this video, we're going to focus on forecasting free cash flows. How do we get those numbers for the free cash flow model? So again, we are going to assume that they're going to grow at a chosen kind of growth rate, and we want to try to predict what we think that growth rate might be. So to get there, we need to start with a forecast of net operating profit after taxes. This is a pretty simple formula. It's EBIT, earnings before interest and taxes, multiplied by 1 minus the tax rate. But we also need to know the total net operating capital as a percentage of sales. So this will help us understand how much sales we need based on our operating capital, and also let us recognize then that earnings or operating profit stems from that operating capital, obviously. So here's the data we have for this company. It has sales of $2,000. The total net operating capital is 1.12. Operating profit ratio, that's NOPAT, right? Net operating profit after taxes divided by sales. In this case, they have a 4.5% ratio. And their capital requirement ratio, which is their operating capital divided by sales, is 56%. And the target weighted average cost of capital for the firm is 9%. So what we need to do now, right? Let's make an assumption. What are the operating assumptions if we assume there's no change? The operating ratios remain unchanged. Sales are going to grow by what we expect, which we expected to go 10, 8, 5, and 5. And of course, the long-term growth rate in sales, 5%. And again, our targeted weighted average cost of capital is 9%. So let's see if we can work through some of this data. It's nice if we can create a spreadsheet. And here's our spreadsheet that has our inputs. These are all the numbers that we've just established in our previous assumptions. So now let's start to think about how we can forecast the items that we need to forecast free cash flow. So what would the sales be in year one? Well, it's $2,000 times the 10% growth rate, $2,200. What is NOPAT? NOPAT, net operating profit after taxes, has historically, maybe that's where we got this number, is 0.045 or 4.5% of sales. In this case, $99. Operating capital is established that we need around 56% of our sales. We need to have that in operating capital. So that means we need $1,232 of capital in order to sustain this level of sales. Now, free cash flow is that NOPAT number minus the operating cash flows, operating capital T minus the operating capital. I think that should be T minus 1. That's the change. The return on invested capital for a certain time frame then is NOPAT divided by the operating cash flow. So let's take a look at this number. And again, I think this should have a T minus 0 here, or T minus 1 to show the change. But here's the worksheet that's created. Again, for us, this is in our workbook. It's a free cash flow worksheet. Here's the data again from our table above. Now we just need to forecast our sales. So again, this sales item, right, grows. So next year is expected to be 2,200, and then 8% of that, 5% of that, etc. Likewise for NOPAT, every year the change is based on the percentage that's been forecasted before. For the NOPAT divided by sales and operating capital divided by sales, Those are fixed, so they're not going to change. It's just the same number each year. But in case you had some predicted change, you would input that difference of growth here, much like we did with the sales growth. That would obviously be followed in the numbers down below here. So again, we find out that the free cash flow for this company is negative 13, 8.3, 45.7, 48.025. So what is the growth rate in free cash flow? Again, if you look, you just take the ending cash flow divided by the beginning cash flow. So over a year, from year 1 to year 2, grows negative 164, 447, then 5. So we can see that the actual growth in free cash flows from year to year varies wildly, right? It can have some very big swings. We also want to be able to calculate the return on invested capital. We can see in general, the first year it's 8.8%, but then for the next years, it's all the same, 8.04%. So here's our basic idea here then is, what is the holding value? What is the value at the end of the 4th year? We need to know the free cash flow in year 1. We have that right here, 48.025, right? Times 1 minus 0.05 is the growth rate that we expect long term. Here's the weighted average cost capital. So in year 4, we expect it to be 1260. So the present value of that, take the present value of that 1260, is 893. So now we need to calculate the present value of the free cash flows. Again, if you do that, here's negative 13. Here are our cash flows. Here's the growth rate, right, or the weighted average cost of capital. So the present value of the free cash flows is 64.45. So now we can plug those numbers into our calculation here, where we have, here are our growth numbers, our values. Here's 9%. And what we find here is $893 is the long term. $64 is the value generated by short term. So again, we can calculate this intrinsic value based on those cash flows that we predicted. Again, if we wanted to do the math real quick, 890 divided by 957 is a pretty high number. So we're certainly over the 80% that we had talked about before. And in fact, down here in the notes, I think if you can't see it here, but it says it's about 93%. So 93% of this company's value is coming from the long-term strategy and decision making that the company has made. That is it says something about the sustainability of the company. If it was all geared towards the short term, we would worry about whether or not the company could last in the long term. Now, the nice thing about using a spreadsheet is that we can look at how sensitive these variables are. And there are 4 variables that we want to talk about. So they refer to these as value drivers, the things that are driving this valuation technique. It's the sales growth rates, operating profitability, capital requirements, and the cost of capital. So let's look at what would happen to these numbers if we had higher growth rate, right? So higher growth rate is going to have an impact, obviously, on the numbers. So let's say that the growth rate that we predict is not 10.8555, is 11.9666. So in general, everything goes up by 1%. The other variables stay the same. So what happens to ROIC? It stays the same. But what happens to the value of the company? Higher growth causes the value of operations to fall, right? So ROIC has to be greater than this formula, the cost of capital divided by 1 plus the cost of capital, for growth to add value. So you need to have higher returns than the cost of capital to get growth. And hopefully I think that makes sense, right? If all the expenses are incorporated in profits, and then we incorporate and look at the rate of return on our investments, that has to be higher than the cost of getting those investments. So in this case, ROIC has to be greater than 8.26 in order for higher growth rates of cash flows to actually add value to the company. So just blatantly say, will higher growth rates of free cash flow increase the value of the company? On the surface, that sounds like a no-brainer question. Well, certainly higher growth rates should add value. However, we have to incorporate it into the operations of the company. Just because you're getting higher growth rates does not mean that you're getting higher returns on your invested capital. What about higher operating profitability? Again, if you notice here, we switched back the growth rates to where they were, and now we have operating capital increases. So this is the higher operating profitability. If you make more money, what happens? Well, in this case, higher operating profitability increases ROIC. And of course, we said before, that number has to be greater than 8.26 in order for us to see growth in value. And in this course, we can see that just a 1% increase in operating profit is a tremendous increase in the value of operations. So it goes up $6,000, which is what, almost 66% increase in value with a 1% increase in operations. Now, what about the lower capital requirements? What if for some reason now we need less capital than we used to? So what will that do, again, to ROIC? In this case, again, all the other numbers went back, and now we dropped from 56 to 51%. When you do the calculations, the return on invested capital drops from increases to 8.8%. And again, since that's higher than 8.26, that means higher return on invested capital is going to increase the value of operations. Now, this is a pretty substantial drop. 5% is a pretty big drop in capital requirements. But again, we could actually, in Excel, do some what if questions, right? What if we wanted to understand if we wanted to get a return on invested capital of 8.26%, what is the lowest that the capital requirement could go to get us there? Hopefully, I think that made sense. You can ask these solver types of questions. And of course, if we know the minimum, then we can say, well, if we just do a little bit more, if we could get a little bit more, that will give us, again, some increase in value. As management, then we need to understand that situation, right? So maybe we want to say, well, what are these values to get in combination? Well, let's look at this. So what if we say, well, look, what if we could make some improvement in operating profit and in the capital requirements? In this case, as you see, the return on invested capital increases dramatically. So we're going to have a tremendous increase, almost a twofold increase in the value of operations, because both of these things we were able to find improvements. And again, we can do this again. What if we make changes in growth, operating profits, and we can just make the changes as we want to see ultimately how much change will happen. In this case, if growth goes up and operating profits go up and capital requirements go down, it's going to have a tremendous impact on return on invested capital, which is obviously then going to have a huge change on the value of the firm, since again 8.26 was the amount we needed to hit just to break even, if you will. Of course, we can create tables, looks at some growth rate, looks at some return on invested capital, and we could find out those places where we would find the maximum amount of, or the maximum value of the firm under those particular variable changes. So again, I don't want to spend a lot of time on this, but again, we need to understand, I guess, that just changing operating profit may or may not change value. It depends on how it flows through to the return on invested capital. So let's come back to a question is talk about, stock prices in general, right? Are volatile stock prices consistent with rational pricing? And we can see here that small changes can cause large value changes. Weighted average cost of capital certainly could have the biggest changes. So as investors get new information, they're going to update their estimates, right? If stocks aren't volatile, if they aren't moving fairly dramatically, then this could mean there isn't a good flow of information, right? So we need to understand that the information that investors get from this type of analysis drives how they want to invest. So as managers, what do we need to do? I mean, I hope maybe it's clear, right, that we need to manage what we think future growth rate's going to be, operating profit, and the capital requirements. And of course, we need to find ways to minimize our weighted average cost of capital so that in the end, we can maximize the value for our shareholders. So information is important. Investors use this information. And now we kind of see that there's a little bit of a key or an idea of how you can manage a company in order to maximize the value that goes towards shareholders. So I hope that kind of gave us a little bit of idea of decision making, and I'll see you in the next video.